Okay, I think we can get started now. We're just about right at 1 o'clock. And just wanted to introduce myself. For those who don't know me, I'm Liz Gagnon, a supervising project manager at the FASB. And I just wanted to thank you all for your interest and participation today at our semi-annual CPE Provider Forum. First, I just wanted to begin with introducing our presenters today, who will be with us throughout the forum to assist with questions. And I'll just briefly turn it over to each one of them so you can have a face with the name. And I'll start with Fred Cannon, who's one of our board members. So Fred, you just want to say a quick hello?
Thanks, Liz. Yes, a quick hello. I'm Fred Cannon, the newest member of the board. I began just a little less than a year ago. It was July 1st of last year, and I come from a user background. Glad to be here. I look forward to working with all of you and hopefully meeting in person soon.
Great. Thanks, Fred. Next, I'll turn it over to Nellie.
Hi, everyone. I'm Nellie Debler. I'm the Deputy Technical Director, and I've been with the FASB for almost a year now.
Great. Thanks, Nellie. And then Jeff.
And I'm Jeff Mechanic. I'm an Assistant Technical Director here, and I oversee all of our activities having to do with private companies and not-for-profit organizations. Again, it's great to be with you here today.
Thanks, Jeff. So just wanted to, before we begin, just touch upon some housekeeping items. The forum is intended to allow CPE providers an opportunity to inquire about final and proposed accounting standards with board members and FASB staff with the goal of assisting in your preparation of accounting and reporting courses. And just as a reminder, this is open to standalone CPE providers whose primary business is to provide CPE, as well as individuals who provide CPE within their organization, so such as a CPA firm or to their organization's clients. The slide presentation will be available for your viewing during the webcast. It's also available to download on our website, fasb.org, under Educational Webcasts and Webinars tab. We also will put a link in the chat feature so that you can also access this through that. We encourage you to ask questions during the forum in the Q&A feature, not the chat feature, at the bottom of the screen during the presentation. And if possible, it would be best if you tried to ask the questions pertaining to each topic as those topics are being discussed, but we do have time at the end of the forum to answer questions as well. We plan to be flexible with the agenda depending on the number of questions we get during the forum, and we'll try to answer all of them. However, we may not be able to get to them all given time constraints. If we cannot get to your questions, feel free to reach out to the teams individually for further follow-up or additional questions. And the views that are discussed today are based on the individual speaking, not necessarily representative of the views from all of the FASB members. Next, we just wanted to touch upon the agenda for today, and we're going to begin with current hot topics, implementation of new standards, and recently issued ASUs. Then we'll have a discussion about the board's technical and research agenda, the agenda consultation, current projects, and finishing with any remaining Q&A. Before we begin, we are going to be sending out a survey after the session to get some more feedback for future CPE provider forums. We are trying to get, as we have surveyed you guys in the past, it would be, we thought perhaps in the future, if any of you are interested in having more of an interactive dialogue and want to come on and join as a participant, an active participant, we'd like to hear that from you. So if you or someone from your organization would be willing to be an active participant, please put that in the survey. And a link to the archive webcast will be sent out after the forum and will be available for about 6 months. So just now we can move it on to the first topic, and I'm going to turn it over to Jeff Mechanic, who's going to touch upon a little bit of a reminder and some of the COVID-19 related assistance. So Jeff.
Thanks, Liz. And again, this is definitely a bit of deja vu. We've been talking about a lot of this over the last couple of years worth of CPE provider forums. So let's go to the next slide, please. And one more. So this is probably a pretty familiar slide to all of you. This is a slide that reminds you that we do have a one-stop shop on the FASB's website, a go-to page. Which this link here, FASB response to COVID-19, will take you to. And on that page, you can find resources that we've put out over the last couple of years including a few very important staff documents, a couple of staff question and answer documents, one on lease concessions such as rent deferrals, and one on hedge effectiveness testing in these kinds of uncertain times. And then also a staff educational paper on loan and other debt modifications. Again, we've covered this in some detail, all of those in past webcasts. Also want to remind you that there is a free technical inquiry service that the FASB provides. If you're not already familiar with it, please, you now are, and please feel free to avail yourself of that. If you have any question on anything you can't find your answer to on this or other FASB web pages. Let's move on to the next slide. And this slide here is a summary of, a tabular summary of an area that I've spent a lot of time on over the past couple of years in these and other webcasts, and that is a lot of the federal assistance programs. And you'll see on this, in this table, all sorts of links to documents. And these are documents that have been put out by others, such as the AICPA, that the FASB staff has reviewed these documents for consistency with GAAP prior to issuance. But again, this is where you can find the guidance that I'll be briefly mentioning. And what I'm going to be spending my time primarily here is on things that are relatively newer or that I haven't spent as much time on in the past. So one that I've spent a lot of time on is the Paycheck Protection Program. And many of you, if not all of you, have fielded questions on that. The AICPA issued some TQAs back in the middle of 2020 on those. And those TQAs point out the models that are available for accounting for this type of assistance, depending on whether or not you're seeking forgiveness or your client, this organization, is seeking forgiveness. Either a loan forgiveness model is applicable or a conditional grant model is applicable. If we're talking about a not-for-profit organization and we're talking about a conditional grant model, that would be the model under subtopic 958.605 of the codification. That's the contribution model. If we're talking about a business entity, there's no direct on-point guidance. They're scoped out of that guidance, but they are permitted to either analogize to that guidance or to analogize to the international version of that guidance, which is IAS 20. There's one other possible model, but one we haven't heard much being used for this type of assistance, and that is the gain contingency guidance. And there's all sorts of judgments that are involved in this area, particularly in the conditional grant model. The judgment about whether the review and forgiveness process isn't something that would affect the timing of recognition of any revenue or gain here. The second of these programs is the Higher Education Emergency Relief Funds, and the guidance that I have a link here to is from the National Association of College and University Business Officers, NACUBO. Here, what we're talking about is our conditional grants for a couple of different purposes: for direct aid to students who may be incurring COVID-related expenses, as well as monies to the institution, to the college or university, to reimburse them for lost revenues or the costs of taking courses online or otherwise spending on COVID-related expenses. Again, conditional grant model, most colleges and universities are not-for-profits, so we're primarily talking about subtopic 958.605, but if you have a for-profit university, they alternatively could use IAS 20 to account for that. And one of the key issues that NACUBO addresses in their tutorials is a couple different views about possible linkage in the timing of recognition of the institutional portion versus the timing of the granting of the direct aid to students. And again, I'll refer you to the NACUBO tutorials. Here's the link for more on that. One that many of you may have received questions on and may continuing to be receiving questions on is the healthcare provider relief funds. These are the AICPA TQAs, the link to those. They've actually had a couple of rounds of those originally in the middle of 2020. They revised those in the spring of 2021. And part of the reason that they revised those is because the guidance from the Department of Human Services has evolved over the months, seemingly on a monthly basis at times. Here we're talking about a combination of some of those monies being under a conditional grant model. Again, for a for-profit healthcare provider, it would be either IAS 20 or 958.605. For a not-for-profit, we're talking about 958.605. But there are some monies that are reimbursements to a healthcare provider for for testing and treating the uninsured. That actually is under topic 606 because being reimbursed at Medicare rates for amounts that would otherwise have to be written off to charity care or to an implicit price concession allows for additional revenue recognition, and what these monies would be third-party payments against that. One that the AICPA has not put out TQAs on, but which we continue to get questions about seemingly on every webcast and every speech, and the AICPA continues to get questions on, are employee retention credits. One of the questions that we hear is, are these income taxes or credits against income taxes? The answer is no. Again, first, I do need to say that I am speaking as a FASB staff person. This is not an official view of the board, but employee retention credits are not determined based on taxable income, that sort of thing. It's a reimbursement for paying for payroll taxes. So it's under, it's relates to payroll taxes. So what we're talking about there is not the accounting for income taxes, but again, you're in a conditional grant model. If you are a not-for-profit, we're talking about 958-605. This is going to sound redundant. If you're a for-profit, you could alternatively use IAS 20. And one of the other questions that we in the AICPA get is whether these monies can be netted against payroll expenses. And so the answer, again, with my caveat, is that depends on what model you're using. If you're using 958-605, that would not be permitted. If you're, on the other hand, you're using IAS 20, that is an option under IAS 20. You can either recognize the revenues gross, or you can net down against expenses. Again, not allowed under US GAAP. One that the AICPA, or a couple of programs that the AICPA put some TQAs out relatively late last year. We're on a couple of programs, the shuttered venue operators grants, like for example, for performing arts centers and the like, and the restaurant revitalization fund. And in their TQAs, they point out to the same conditional grant models, depending on whether you're a for-profit or a not-for-profit, that you've been hearing about over the last few minutes, having to do with the Paycheck Protection Program and the provider relief funds and so on. A set of TQAs that the AICPA put out in, I think it was either very end of January or the very beginning of February, was on vaccines, such as COVID-19 vaccines, pharmaceuticals, medical supplies and devices for distribution to specified individuals and groups. And what these TQAs do is they point you first to the guidance to determine whether or not you should be recognizing revenue and corresponding expenses having to do with these, or whether these would instead be reflected as agency transactions, pass-through transactions with just balance sheet impact and no revenues and expenses. They particularly point you to the guidance on pass-throughs and on variance power and things like that in subtopic 958-605. And if you do come to the conclusion that if this should be recognized as revenue and expenses, then it again reminds you of the various models that we've been talking about for a not-for-profit 958-605. And by the way, here, since we're talking about donated, contributed non-financial assets, you would also be subject to the disclosures under ASU 2020-07 on gifts in kind, which Liz is going to be reviewing in a little while. And again, for a for-profit, a business entity, you're in those two possible models, either 958-605 or alternatively IAS 20. So again, lots of guidance that's out there. We've looked at it, before it was posted, with all of these, as we've been stressing on these various webcasts, good disclosure is really important. And with that, I'm going to turn it over to Liz, who's going to talk about an ASU that we put out late last year that deals with disclosure of these types of things.
Thanks, Jeff. So just talking about disclosures about government assistance for business entities. So on this slide, stakeholders have questioned what disclosures about government assistance should be provided, especially given the increase in the amount of government assistance related to COVID-19, as illustrated, as Jeff just discussed on some of those on the last slide. And given that GAAP does not have specific accounting guidance for government grants to business entities, this slide just highlights some of the existing disclosures that companies are required to make relating to accounting policies, and in particular when you have a selection of alternatives, and that often is the case when you're analogizing to various guidance. So moving on to the next slide. In November of last year, the board issued a final standard on disclosures for business entities about government assistance. And the disclosures are required in instances where a business entity is using a grant model by analogy, such as the non-for-profit guidance in 958-605 or an IS-20, as Jeff mentioned, the International Standard for Accounting for Government Grants and Disclosure of Government Assistance. The disclosures are required on an annual basis and are effective for years beginning after December 15, 2021. So that would be for calendar year ends 2022. And early application is permitted. Many are early adopting it, as we understand, and also many of the disclosures are largely consistent with best practices that are already out there for a lot of companies. The project was on the agenda since 2014 with the goal of bringing more transparency to the area where there is no explicit GAAP. And, we've talked a lot about this recently before the standard went out, especially given the large amount of assistance received from the federal government. And users were urging the board to develop some disclosures to bring transparency around the types and the amounts of assistance being provided to companies and how that assistance is reflected in the financial statements. The initial scope of the project was much broader than it is now, and given the concerns that were raised about the potential cost of a broader scope, the scope was narrowed down to just instances where an entity is analogizing to a contribution guidance for grants. So moving on to the next slide. So this gets to really what the disclosures require, and it would be information about the nature of the transactions and relating accounting policies, line items on the balance sheet and income statement that are affected, and you also have to disclose the amounts that are applicable to each financial statement line item, and the significant terms and conditions of the transactions, including the commitments and contingencies. So the timing on this standard is such that, so these disclosures will hit really the tail end of the COVID-19 assistance, but also will be in place for perhaps any other assistance that's provided in the future. Later in the presentation, Nellie is going to talk about some of the recent research projects that were added to the board's agenda, including one related to the accounting for government grants, where we'll gain in some information about IS-20, in particular, whether certain aspects of IS-20 might represent a reasonable starting point for GAAP for recognition, measurement, and presentation guidance. The staff, as part of that project, is planning to put out an invitation to comment on IS-20, and at a later stage, we'll take that feedback to the board and present them with an analysis for them to determine whether they want to take on a technical project to address the overall accounting for government grants. So this slide here just talks about some examples of how you would think about what would be in and what would not be in the scope of the disclosures. So a typical example that comes up a lot is the PPP loan. And on this slide, you can see that if the loan is being accounted for under a debt guidance and being accounted for within the scope of topic 470, that's not analogizing directly to a contribution guidance. That is just that they are actually applying the debt guidance, and therefore they're not in the scope of this disclosures. But if a company determines that a PPP loan should be accounted for under a contribution guidance or a loan, we have in here, we have a forgivable loan. If they're using IS-20 by analogy, then that would be in the scope of the guidance. And then you can also see from this slide that typical things that are in like income tax related assistance in the scope of 740 or other typical just revenue type of contracts with the government, exchange transactions that, for example, are in the scope of topic 606, those would not be in the scope either. We also wanted to mention that even if you're not in the scope of the guidance, so if you're a not-for-profit, for example, or if you're applying a debt model or something and you're not technically in the scope of this guidance, it still would be useful for these disclosures to be used in some of those instances. And non-for-profits can also analogize to this guidance, just as business entities analogize to some other guidance to account for contributions. So moving on to reference rate reform. On this slide, you can go to the next slide. Yep. So the board has been actively, we have touched upon this in previous forums, but just to give an update, the board has been actively monitoring reference rate reform and has added 2 projects to the agenda in response to the issues that have come up. So one is on the deferral of the sunset date of topic 848, and the other one is the fair value hedging. So I'll just start with the deferral of the sunset date of topic 848, which is a narrow scope project to defer the sunset date of the relief in topic 848. So this project was added in December of last year, and the relief is intended to facilitate the effects on financial reporting for the transition period during which entities replace the use of IBORs with alternative reference rate. All tenors of LIBOR were expected to be discontinued on December 31st, 2021, and the relief was initially set to sunset 12 months later on December 31st, 2022. Because major tenors of US LIBOR will be published through June 30th of 2023, the board extended the sunset date to December 31st, 2024, which is 18 months after the last tenors of LIBOR are expected to be discontinued. The board decided to amend the definition of the secured overnight financing rate, overnight index swap rate, so that any rate based on SOFR, including the forward-looking term versions of SOFR, meets the definition and therefore qualifies as a benchmark interest rate for purposes of applying hedge accounting. For this part of the project, so an exposure draft encompassing those 2 changes is expected to be issued in the second quarter of 2022 with a 45-day comment period. And the fair value hedging project focuses on developing a principles-based approach for the determination of interest rates eligible for fair value hedging. So currently there is a list of interest rates eligible for fair value hedge accounting. In the US, interest rates on the list include, so there's Fed funds effective rate overnight index swap rate. There's the London Interbank Offered Rate. There's the Securities Industry and Financial Markets Association Municipal Swap Rate, the Secured Overnight Financing Rate, Overnight Index Swap Rate, and then last is the US Treasury Rate. The development of a principle is still in initial deliberations with no board decisions that have been made. And the next board meeting is expected to be held in the second quarter of 2022. So before I move on to the next project, I'm just going to check to see if there's any questions that we've gotten. If a reporting entity has a variable rate debt tied to LIBOR that does not contain a fallback provision, should this be disclosed as a contingency? I'm not sure of that answer, but I will get back to you on that, Ralph. Okay, I think we can move on to the next topic, which is Jeff Mechanic. I'm going to turn it back over to him. He's going to take us through ASU 2021-07, which is consensus of the private company council on stock compensation, determining the current price of an underlying share for equity classified share-based awards.
Quite a mouthful, right, Liz?
Yeah.
So yeah, this is an ASU that was developed as a consensus of the private company council, the PCC, and that was endorsed by the board. And it was issued right around the time of the last semi-annual CPE providers webcast, I think in October of last year. And what it tries to do is it tries to simplify and improve an area of financial reporting for non-public business entities, that is private companies that issue equity classified share-based awards. Let's stay on this slide. The PCC added this issue to its agenda in response to feedback from private company stakeholders indicating that determining the fair value of private company share option awards at grant date or upon a modification of the award is often costly and complex. During research and outreach efforts that led to the amendments in this ASU, the PCC received feedback that the current price input, the value of the underlying share, is typically the most difficult input for private companies to estimate. And unlike some of the other inputs where there were already some practical expedients that existed, for example, practical expedients for volatility and for duration, there wasn't one that existed in this area. And so to address that difficulty, the PCC developed a practical expedient for a private company to determine the current price input of equity classified share-based awards issued both to employees and to non-employees using, and you'll hear this phrase a few times, the reasonable application of a reasonable valuation method. That's language that comes right out of the US Treasury regulations that have to do with the income tax reporting here. So let's move on to the next slide. The practical expedient allows a private company to use a value determined, again, by the reasonable application of a reasonable valuation method as the current price for its underlying shares for purposes of determining the fair value of an equity classified award in topic 718, either at grant date or upon a modification. That practical expedient describes the characteristics of that reasonable application of a reasonable valuation method. I'll show you on the next slide, we'll have that. The practical expedient, very importantly, is applied on a measurement date by measurement date basis. So if a couple of different awards have been granted on the same measurement date or using the same measurement date, if you elect to use this expedient for one, you must elect to use it for any others that you're using the same measurement date. And again, it can be elected for equity classified awards within the scope of topic 718 that are issued both to employees and non-employees, and that a private company must disclose this election. Lastly, the practical expedient in this ASU is effective prospectively for all qualifying awards granted or modified during fiscal years beginning after December 15, 2021. So that's calendar 2022. And then for interim periods, the following year. Very importantly, early application, including application in an interim period, is permitted for financial statements that have not yet been issued or made available for issuance as of October 25th, 2021. That was the date of issuance of this ASU. Let's move on to the next slide. So the practical expedient describes the characteristics, as I mentioned, of that reasonable application of a reasonable valuation method that should be considered. And that's what's listed here. You have the value of tangible and intangible assets, present value of anticipated future cash flows, et cetera, et cetera. This, as I said, is consistent with, these are the same characteristics as the Treasury regulations that pertain to Internal Revenue Code section 409A, at least the version of that existed as of the issuance date last October of this ASU. And again, these are detailed in paragraphs 718, 10, 30, 20E, and 20F. Again, it's the same characteristics that are listed in the Treasury regulations, and would further say that a reasonable valuation performed in accordance with Treasury regulations are therefore an example of how to achieve this practical expedient. Let's go on to the last slide in this area, in this section. Now, the PCC agreed that in certain circumstances, the practical expedient here may provide benefits to private companies by reducing the number of valuations that a company would obtain over a 12-month period, and by clarifying an acceptable practice that's already being used by many for determining the current price input, anyway, codifying that into GAAP, and therefore eliminating some of the potential confusion in that area as to whether that's acceptable or not. And also, this would also potentially provide benefits if a company currently obtains two independent valuations to satisfy both GAAP and tax purposes separately. There'd also be a potential benefit there. Again, that may not generally be the case, but that certainly could be the case. So we're talking about an ASU that could have some benefit, not earth-shattering in many cases, but benefit to some companies, and therefore could be beneficial to some private in some instances. Let's move on to another ASU that was also issued late last year, and that is ASU 2021-08. Now, the amendments in this ASU provide an exception to fair value measurement for contract assets and contract liabilities acquired in a business combination. And the aim here is to improve the comparability in the accounting and reporting of acquired revenue contracts, both as part of a business combination and then also in after the business combination has occurred and in the subsequent accounting. With this ASU, topic 805, that is business combinations, now says that the acquirer will generally carry over to their financial statements the contract assets and contract liabilities of the acquiree based on how those balances are recognized and measured on the acquiree's balance sheet under topic 606. In other words, the acquirer would use the contract transaction price approach under topic 606 rather than fair value, both for contracts arising out of sales to customers in the ordinary course of business, the main topic of scope of topic 606, as well as those one-off sales of non-financial assets that are also covered under the RevRec guidance. It's important to note here that the scope only includes contract assets and contract liabilities, not related assets or liabilities that may arise under topic 606 or 805. For example, those associated with favorable or unfavorable price terms. Now, I said generally before this, you generally would carry things over because there could be some necessary conforming that may need to happen because of differing policies and judgments between the acquiree and the acquirer. But again, that would be the general rule, a general requirement. The board also decided to provide some practical expedients here to the recognition and measurement guidance in 606 around completed contracts and a couple other things. Now, all of this should maintain or reduce costs for preparers of financial statements compared to the current diverse practice in this area. It would also reduce investor costs of having to analyze and interpret the reported information that might differ company to company. It also provides investors with some more decision-useful information. It's important to note that there are no additional disclosures related to the amendments here, as the board concluded that the existing disclosures in topics 805 and 606 would provide sufficient information for acquired contracts with customers. You'll note that this is not effective for private companies until 2024, but it can be early adopted. So if any of your clients have any upcoming business acquisitions, they might want to consider this ASU. And with that, I think we're done with this section. And Liz, we could see if there's any questions here before turning it over to Fred to begin talking about PIR.
Yeah, no, it doesn't look like there's any additional questions.
Okay, so then off to Fred.
Thanks, Jeff. And thanks for that review. Yeah, I'd like to spend some time talking about post-implementation review. I'll specifically focus in on CECIL and then hand it back to Jeff and Liz on some other major standards. I think it's important to recognize that FASB's work doesn't end when an ASU is issued. We have a very detailed plan for post-implementation review to ensure that the standard is being applied as it was expected to be, and to make changes where appropriate to determine when and if there's something that can be adjusted to better achieve the aims of the standard. So what is post-implementation review? It is a fairly long process. I think it can last 5 years or more, but it's really to determine whether the standard is accomplishing its stated purpose, to evaluate input and especially look at benefits and costs, to provide feedback to improve the standard setting process, and in select cases, as we'll discuss, to actually make some adjustments to better meet the needs of financial statement users and preparers and all of our stakeholders. I think it's important to recognize, and then certainly from my standpoint, that the PIR process is not a process to relitigate a standard. It's not to reestablish or move away from the standard. Really, it's to say, what is going on with the implementation of the standard? And are there some things perhaps that the board didn't anticipate that can be adjusted? Or are there things that we learned during the process where we can make some changes or assist in the process? And so you can see that the PIR process is conducted by FASB at this point in time. That was a change in December 13th of 2020. Prior to that point, the PIR process was done by the FAF Board of Trustees, which is our overseeing organization. although the work was done by a lot of the staff of FASB, I have to admit. But it was the, but currently we have moved that to the FASB. And then of course we report to the FAF in terms of the implementation and progress reports. There have been 14 PRs completed to date under FAF. And so as we put forward new major standards, that's when we put in process, the PR process. Next slide, please. So in terms of the stages, the first stage you can see is really monitoring implementation, what's happening, watching how the standard is playing itself out in terms of financial reports. The second stage is really looking at the costs and the benefits. And then third is a summary of all that work that goes back up to the FAF and the board itself. The PRs that are currently in process are based on the RevRec topic 606. Which has been ongoing, and we'll hear about some of the process there. Leases, 842, and then credit losses, the most recent implemented standard, 326. I would highlight that we do have a link for more information on the PR process here on the slide. Next slide. Just a bit of a quick reminder in terms of upcoming effective dates for major standards. Leases, I think it's focused on it had been deferred twice, but non-public companies, the board has reaffirmed that it will be need to be implemented by calendar year 2022. CECIL again had been delayed, but now the board did reaffirm recently that it will be implemented in calendar year 2023 for all the small reporting companies and non-publics that had not yet implemented CECIL. And you can see hedging and the insurance standard also with the effective dates that we currently have. Yeah, I think you're pretty much, you all are pretty much aware of this, but just to reiterate, the phasing of the standards for generally public or large filers to smaller and non-publics is really designed to be part of the PR process to the extent that we can make adjustments prior to broader implementation from the initial implementation. And we have a link here on this slide in terms of the all the dates of the implementation of standards. Moving ahead, I'd like to spend a little bit of time talking about CECIL and where we are in terms of the implementation and the standard. Of course, CECIL by large reporting companies was implemented in 2020. It was, of course, a auspicious time period to implement a major credit standard related to banks and financials at the same time that the pandemic hit, I guess, what would have been, Jeff, 10 weeks after the implementation date. So that made the PA process especially interesting for CECIL. Just a quick reminder, which I'm sure you're mostly aware in terms of what does the, who does it affect, what does it affect? It's important to recognize it's not just loan and debt instruments not measured at fair value, because we have the fair value option in CECIL, but also financial guarantee contracts, certain lease receivables, and trade receivables. So of course, CECIL has broad implications well beyond the financial service sector. Next slide, please. In terms of the post-implementation review, as I was discussing earlier in terms of the objective is really to say, is CECIL accomplishing its stated purpose, which is to provide financial users with more decision useful information about expected credit losses. And if we remember, really the CECIL was implemented largely to address the issue of delayed recognition of credit losses. And the objective is also to evaluate the implementation and compliance costs related to the benefits. The status, since implementation, the staff has been working hard to analyze exactly what has been coming out in terms of reporting, monitoring the variation that we've seen in CECIL accounting, and in addition, hosted a public roundtable on May 20th of 2021 with users and broad group of stakeholders to talk about implementation, what we've learned, and specifically a topic we'll talk about in a minute, and that's PCD and TDR accounting. Some milestones, I think one of the ones that's coming up very quickly is what we'll talk about in a minute, is the update that we're going to be putting out shortly on troubled debt restructures and vintage disclosures. This was something that came up very early in terms of the post-implementation review. In addition, currently we're having ongoing discussions about the accounting for acquired financial assets and PCD accounting. So, but again, this is not, two and done type of process. It will be a continuing process. There's a lot of things to learn from the PIR process, and there's a lot of issues with this ASU in terms of maturity, is watching over time how things evolve. So next slide, please. So let's talk a minute about acquired financial assets and the accounting for them, and this is an ongoing discussion. This is an issue that came to the board quite early in the PIR process. And really the issue goes back to purchase credit deteriorated assets. And this gets back to the issue that was debated extensively at the board during the development of the CECIL process. And that really gets down to with CECIL for originated or recently originated loans is really saying, hey, I'm originating a loan. I know there's going to be credit losses. I'm going to take a charge for that credit loss expectation of that originated loan. The challenge has always been, what about a loan that was acquired from another entity? And perhaps that entity had already started to take into account credit loss. Perhaps you paid a discount related to credit loss. How does that work? One of the things about that was that the challenge for users is coming out of the old SOP 033 approach, was that by purchasing loans at a discount and incorporating that into net interest margin, users had told the board consistently that that is problematic, because the net interest margin that's so important to financial statement users then has a mix of both credit and interest rate cost to it. And so the board tried to address that through PCD accounting. And that is basically saying, hey, if I have a mature loan, I'm going to apply purchase credit deteriorated accounting, which essentially allows me to buy that loan at a discount, gross up the credit portion of that discount into my allowance, and then have continue to accrete net interest income based on that grossed up amount, and have credit issues go through the reserve and the allowance. That was the board's intent. The challenge was that what happened following implementation was that a much greater amount of loans were getting non-PCD treatment than was expected. In terms of mergers and acquisitions, what we saw was that 50 to 80% of loans purchased in an acquisition were being treated as non-PCD, as originated loans, and only a small portion were getting that gross up approach. The challenge for that for users was suddenly users had the continued problem of having to try and differentiate a net interest margin that incorporated both credit costs and interest income. And so really, it was that issue that came to the board. We heard that at the roundtable, and the current board is trying to address that. And really, when it gets down to, at least in this board member's opinion, is that the definition of a PCD loan, purchase credit deteriorated, that has more than insignificant credit deterioration since origination, became very, in my view, again, difficult to identify. And as a result, fewer than expected loans were being identified as PCD and getting that gross up treatment. So the board, as a result, is taking an approach and sitting back and saying, hey, is there a way to expand PCD accounting to have that gross up accounting apply to a broader range of purchase loans, and have that accounting that separates credit and interest rate, that's what users want, on a broader scale. And that's really where we're at today. We have had some initial views and feedback in terms of trying to think about expanding the PCD. The board is leaning towards a broader expansion of PCD accounting. And that's where the leanings of the board currently are. However, this is an issue that we will continue to discuss. One of the things I would highlight in this slide, the board decided that the PCD accounting should be applied to all acquired financial assets. All is an interesting term here because it's not all. There's a real issue about a recently acquired loan that looks a lot like, or very recently acquired loan that looks like an originated loan that probably, at least in this board member's view, shouldn't get PCD accounting. And so really the issue is what kind of seasoning should we apply in terms of loans or recently originated and recently originated loans before they get that PCD accounting. And that's something that we'll be continuing to discuss. We're going to continue, and that's an ongoing process, but this is a topic that we are in current discussion on in a current project. The second issue that is part of the PIR process that is moving through even more quickly, and we've really resolved this issue, is the accounting for TDRs for creditors and also vintage disclosures. So on TDRs, it's important to recognize the background of this was that right after the implementation of CECIL and the onset of the pandemic, the CARES Act was passed in Congress that addressed TDR accounting and suspended TDR accounting during the period of the pandemic. That expansion is ending during the first quarter of this year, and so as a result, there's significant focus on the board to say, hey, this was suspended during the pandemic. Is this TDR accounting something that we should continue to maintain in terms of an accounting standard or not? And essentially the board has decided to eliminate TDR accounting, but replace that TDR accounting with some significant disclosures of modifications. The background of that is that during the pandemic, even though TDR was suspended, banks and other lenders voluntarily provided some significantly important information on modifications. And so that mix of TDR suspension plus disclosure on modifications seems to be something that we heard from both preparers, users, and all stakeholders made sense on a go-forward basis. And so that's really what this this ASU that we are going to be issuing shortly really says. We suspend TDRs, but we provide users enhanced disclosures concerning modifications, specifically modifications that are meaningful in terms of interest rate, term, or principal reductions. Next slide. Okay. So this slide really kind of underscores what some of the issues that I just recently raised in terms of recognition and measurement, TDR elimination. It does have a concept, as I was mentioning, in significant delays in payment won't be part of this this disclosure. The disclosures, we do believe will really enhance an ability to for users to understand what's happening with modifications and follow that on an ongoing basis. And also the transition allows for, because I did want to talk in a minute about the issue of vintage disclosures, it allows for early adoption for companies because of that first quarter 2022 deadline in terms of TDRs, early adoption for companies to suspend their TDR, eliminate their TDR disclosures, at the same time providing this enhanced disclosure framework in terms of modifications. That transition is separate from the vintage disclosure issue, which I'll touch on briefly. Vintage disclosures, there was a ongoing project that the FASB has had, really ongoing project that's been on the FASB's agenda for a while, trying to clarify about clarification on vintage disclosures. In terms of the vintage disclosures, the issue is that the vintage disclosures that were required, there was a question mark as to whether gross write-offs would be needed for those vintage disclosures, and also gross recoveries. There was some confusion in terms of the way what was occurring was because we had in the ASU, there was an example that included gross write-offs and gross recoveries that was not included in the text. As a result, the board said that that would not be required. And I think, as far as I know, only a very few number of companies did require that. What we heard from users quite clearly in terms of the vintages is that that gross write-off information is critical information to understanding the credit trends from the vintage tables. In other words, without the write-offs as part of the vintage table, it was very difficult to say whether credit's improving or deteriorating if you don't know whether the change in the amount of any vintage loans, the change in amount was because of payoffs or because of write-offs. And what we heard was gross write-off information is very important. Recoveries, not so much. So as a result, the board did vote to include a requirement to include gross write-offs as well as into the vintage disclosures. That project was combined with this, and so as a result, as we put the ASU out later this quarter, there's actually not too many days left in this quarter, if I can look at my calendar correctly, that those will be combined in this. So the ASU will both do really three things: suspend or eliminate TDR accounting, provide enhanced disclosures in terms of modifications, and require the gross write-offs in the vintage tables. Now that piece of it will not be, the one thing that's important to recognize in terms of transition is that the vintage, the transition to vintage is separate from the TDR piece of the puzzle, so to speak, and that that will be implemented in 2023. With that, I think I've covered CECIL. We're continuing on our PIR discussion, and I'll hand it back to Jeff to discuss leases. Thanks.
All right, so we're continuing with the PIR journey. Thanks, Fred. So, as Fred mentioned, we have a few different PIR projects formally on our agenda. Fred updated you on the CECIL credit losses one. I'm going to update you on the leases one. And as with the credit losses PIR, this project has a similar objective to see if the standard is functioning as intended and so forth. And the stage where we're at here is that we are seeking post-implementation feedback from those companies who've already implemented, that's basically public companies, as well as the users of their financial statements. And at the same time, we're monitoring implementation for those who are still in the process of implementing the standard. There we're talking about private companies, as well as those not-for-profits that don't have public debt. As with the CECIL standard, the board during this post-implementation review process has continued to look for areas where standard setting may be, follow-up standard setting may be necessary. And indeed, since the LISA standard was issued back in 2016, the board has issued a number of follow-up ASUs that we've talked about on prior webcasts. One that I like to remind people about as their clients and organizations are implementing this new standard is ASU 2018-11. Some of you may recall that that is the standard that introduced an alternative transition approach. Prior to that ASU, there was only one transition approach, which was retrospective, which meant that for any comparative years presented, along with the current year, you'd likewise have to put up an asset and a liability corresponding to an operating lease, as well as do the new disclosures for that prior year as well. But what ASU 2018-11 does is it allows for an alternative transition approach where you leave any prior years untouched including you don't have to do the new disclosures for any prior years, and you would just put up an asset and the liability and do the disclosures for the current year, for the year of implementation. So it's always a good one to remind people about. On this slide, we have here the two ASUs that the board issued last year. We talked about ASU 2020-105 in one of last year's webcasts. It has much more limited type of applicability than the one I'm going to focus on, 2020-109. 2020-105 has to do with certain types of leases with variable lease payments and day one losses and how to and the ASU makes some changes that avoids some non-intuitive day one losses. But ASU 2020-109, which I'm going to talk about in a moment, is one that has widespread implication for private companies and not-for-profit organizations. And that has to do with the lessee discount rate and the risk-free rate discount rate alternative. But before I get on to that, I just wanted to talk about next steps. Very importantly, Nellie's going to talk about later on the invitation to comment on the FASB's future agenda that we put out last year, and we're now in the process of responding to what we heard in feedback from that agenda consultation. And included in that feedback was a feedback on our existing project in the area of leases on lease modifications. And again, you'll be hearing more about that in future months as the staff reviews with the board what's been heard and brings these various projects and potential projects to the board for some decision making. And at the same time as we're also continuing to do additional user outreach on decision usefulness of the information. So let's move on to the next slide. And that is ASU 2020-109. It's very important to note here the title, that's the discount rate for lessees that are not public business entities. It's important to note that that includes all private companies and all not-for-profits, whether or not the not-for-profit has public debt. So this risk-free rate alternative, which is now being modified and improved, I'd say, is available to all not-for-profits as well as all private companies. And so what is this risk-free rate alternative about? Well, it is an alternative to choose a risk-free rate, be repetitive, in lieu of using the incremental borrowing rate of a company or an organization to discount back minimum lease payments to put on the balance sheet as a liability and initially as a right of use asset. Right now, that alternative up until this ASU, before this ASU, that alternative was all or nothing, meaning you had to elect it for all of your leases in order to be able to use a risk-free rate alternative. And the purpose of that alternative was to give companies and organizations a cost-beneficial alternative to having to determine their incremental borrowing rate, especially for companies and organizations that didn't do a lot of borrowing and may not really easily be able to come up with that number, that rate. Anyway, using a risk-free rate, however, is in a low interest rate environment, which we've had up until recently, and maybe for a little longer at least, it's a big disincentive because what that results in, as you guys know, is a large liability, which could really affect leverage ratios and the like. So what we had was were stakeholders coming to us and asking if there was an alternative here that could make it more attractive to use a risk-free rate. And one of those alternatives that was brought to us was, well, maybe instead we could specify some sort of intermediate rate as an alternative, say a single A or a triple B corporate borrowing rate or something like that. Well, the board did look into that, but the feedback that it had and what the staff researched indicated that that would be not very practical to be able to implement something like that, as opposed to what the board ultimately did, which was to modify the risk-free rate alternative, keep a risk-free rate alternative and modify it to be, and let's actually move on to the next slide because this has all the punchlines for the issues that are on that slide. So the board modified that alternative to make it no longer an all or nothing alternative, but rather to make it an election based on an class by class basis for the underlying assets. So for example, if if interest rates were fairly low still, and using a risk-free rate, a low risk-free rate might cause a very large liability and affect leverage ratios. Well, it might behoove the company or the organization to do a little bit of research and so forth, and try to come up with an incremental borrowing rate for their large leases, their material leases, such as big office space leases and so forth, and keep the risk-free rate alternative for smaller leases like equipment or vehicle leases. So that could be something that might be a really attractive alternative for a company going forward to take that type of an approach. And this tweaking of the guidance here allows for that type of an approach by making the election on an underlying asset class by underlying asset class basis. The ASU also did a couple of other things. It clarified that, if you recall the guidance, that the first rate that you're supposed to look to before you even get to an incremental borrowing rate or a risk-free rate alternative to an incremental borrowing rate is the rate implicit in the lease. Not that that is generally known by the lessee as opposed to the lessor, but if for some reason it is readily known by the lessee, then it must be used rather than either a risk-free rate or an incremental borrowing rate. And again, that's regardless of whether the organization has made a risk-free rate election. And then finally, this does require the reporting entity to disclose whether and for what asset classes it has elected the risk-free rate alternative. As I mentioned already, the board did not change the discount rate involved here. It retained a risk-free rate in the alternative. It also considered changing, but did not change the current disclosure about weighted average discount rate. And with that, I guess I have one more slide here, which is about transition and effective date. And this depends on whether or not the organization, the company, has already adopted adopted the new leases standard. If it hasn't yet adopted the new leases standard as of the date of issuance of this ASU, which was November 11th of last year, then there's no special transition provisions. When the organization adopts it, it could make an asset class by asset class election. On the other hand, if the organization had already adopted this, had early adopted, for example, as a private company or a not-for-profit organization, then this provides some transition guidance on dealing with that. So with that, I'm done talking about leases, and I'm going to turn it over to Liz. I guess we can see if there's any questions first, but then turn it over to Liz to talk about gifts in kind.
So Jeff, we did get some questions, but maybe would you like me to move on to gifts in kind, and then you can have a chance to read the questions and then we can come back to them?
Sure. Thanks,
Okay.
Liz.
Okay. So, so moving on to the next topic. So I'm just going to provide an overview of ASU 2020-07, which is on the presentation and disclosures by non-for-profit entities for contributed non-financial assets. So we issued ASU 2020-07 in September of 2020 with the objective of increasing the transparency about contributed non-financial assets, which is gifts in kind, through enhancements to presentation and disclosure of an organization's financial statements. So while we've talked about this ASU in previous forums, we thought it would be helpful to provide a reminder of the guidance considering the upcoming effective date. The scope of the guidance includes all contributions of non-financial assets. We tend to use this term interchangeably with gifts in kind, but it's important to know that while gifts in kind can be broadly defined as including all non-cash gifts, financial assets such as stocks and bonds are excluded from the scope of the guidance. So moving on to the next slide, as an overview, a non-for-profit will be required to present contributed non-financial assets as a separate line item in their statement of activities. This presentation will be supplemented with additional disclosures of a disaggregation by category of non-financial asset. For each category, an organization will also disclose the dollar amount as well as information about how the assets are utilized or monetized, including any associated donor restrictions and the valuation techniques used. The ASU's requirements will help ensure consistency across the sector whenever GICs are significant. So on this slide, contributed services are unique from other categories of contributed non-financial assets because the disclosures were already required by GAAP before the ASU was issued. And as a result, a not-for-profit might have to make disclosures in addition to those previously required by the ASU for recognized contributed services. The pre-existing requirements include describing the programs or activities for which contributed services were used, including nature and extent received for the period and amounts recognized as revenues. Non-for-profits are also encouraged to disclose the fair value of contributed services received but not recognized as revenues if practicable. And as a reminder, non-for-profits are required to recognize contributed services at fair value if the services either create or enhance a non-financial asset or require specialized skills provided by entities or persons possessing those skills, and the organization would need to otherwise purchase those services if not donated. So therefore, recognized contributed services fall within the scope of the ASU, necessitating disclosure as category of contributed non-financial assets and the additional qualitative disclosures. Non-recognized contributed services will require additional disclosure stemming from pre-existing guidance. So moving on to the next slide, the expected date and transition are included on this slide, and the amendments are effective for annual periods beginning after June 15, 2021, and interim periods beginning after June 15, 2022. Early adoption is permitted and retrospective transition is required for all periods presented. So on the next slide here, this is just some of the comments that we received during conferences and webcasts that we've had. And some of the questions are related to the amendments in the ASU and others are not within the scope of the ASU. So questions 1 through 4, I'll go through each one separately, but those two do pertain to the ASU, such as clarifying whether specific contributed assets, such as cryptocurrency and auction items, are within the scope. So in terms of the first question, cryptocurrency would meet the definition of a non-financial asset, and it is subject to the amendments in the ASU. Cryptocurrency does not give you the right to receive cash unless you sell the digital asset, which means that it is a non-financial asset. In terms of the second question, that's about disclosure, which seeks to clarify the requirements in the update about whether all gifts in kinds can be included in the same disclosure as gifts of non-financial assets. And so gifts can be included in the same footnote as gifts of non-financial assets as long as the information is kept distinct, so not as to mix the financial assets and non-financial assets. For the third questions, some of the questions on the presentation expand upon what was included in the update. And the question on this slide asks how to present the expenses that are funded by GICs. The board considered but concluded not to require separate presentation of the expenses that are funded by contributed non-financial assets, as described in paragraph 16 of the basis for conclusions. So in question 4, non-financial assets that are donated for use in auctions, raffles, or fundraising galas are within the scope of the ASU and thus would be subject to the separate line item presentation on the statement of activities and the new disclosures. Assets such as tickets, gift certificates, works of art, and merchandise that are auctioned off to donors would be examples of in-kind contributions that are monetized rather than used. Other in-kind contributions that directly benefit gala attendees, such as free use of a reception hall or live entertainment, would be reflected as both in-kind revenue and part of direct donor benefit, which under existing GAAP could be presented in various possible ways, such as revenue and expense in separate sections or in a netted presentation. In contrast to the items auctioned off, the non-for-profit would disclose that these types of assets were used rather than monetized, but in fundraising activities rather than program activities. The latter treatment as being used in fundraising activities rather than monetized would likewise seem to be appropriate for donated gift certificates and other prizes that aren't auctioned off, but instead raffled off to lucky attendees or to lucky ticket holders in a separate raffle pool. We have received other questions about ASU 2007 for specific fact patterns. And as not-for-profits begin to apply the guidance, we will monitor implementation and the associated questions that arise in practice. As part of our educational efforts on the standard, the FASB held a webcast that provided an overview of the standard and its requirements, as well as illustrations of certain considerations when valuing non-financial contributed assets. The archived webcast is currently available for viewing on the FASB's website. So with that,
Liz,
just
before
wanted-
I was going to say, before we move off of that, there was one new question that was on there, question number 2. I didn't know if you wanted to answer or do you want me to answer?
well, that was on the disclosures, in terms of the materiality.
That's right, that one.
Yeah. So we did touch a little bit upon the disclosures, but, you know, materiality, I mean, I can address that a little more. Materiality, you would have to use materiality just how you would normally use materiality. So if some things are immaterial in total, then you wouldn't have to, you know, you would follow the typical materiality guidance. So you would only have to disclose or separately present gifts in kinds if they are material.
Right.
Is there anything
Like-
else you wanted to add, Jeff?
Yeah,
on
and,
that,
and
on those
likewise,
questions?
likewise, the other parts of the question, likewise, there's a lot of flexibility as to the categories that you use for your footnotes. It'll depend on, you know, what's the nature of your gifts in kind. And finally, you can use an other line if you have some major things and then a whole bunch of small immaterial things, you know, just so you have the total of your disclosure equal the total of your line item. Just make sure your other isn't like 50% of your total. It should be, you know, a fairly small portion. And again, all these answers that Liz has just given and I'm giving, you know, our caveat, we're speaking as FASB staff members. I also see that there's one other question that's come in, and that is, do these apply to for-profit recipients of gifts in kind? And the answer is no. This is just not-for-profit organizations that receive contributed non-financial assets or gifts in kind.
Okay. So that's it for 2020-07.
And I've had a chance now to look at the leases questions, and I can quickly respond
Okay.
to those. Okay, and then I'll turn it over to, I guess it's Nellie next, I think. So Ralph Knack had asked a question, wouldn't it be a presumption that if a lease is between commonly controlled entities, the lessee would not be able to assert that it cannot determine the implicit interest rate? I don't know if I can really answer that. I think you could probably surmise that it might be a little bit more difficult to that. I guess it depends on what kind of Chinese wall you have up between the different entities under common control. And again, I'm not sure I could say much more than that. On the other hand, with regard to 2 other questions, I think I can answer more clearly. When you use a risk-free rate, is there a need to add something like 1% to it, or just the rate such as the T-bill rate on the date of the agreement or promise? So we're talking about a risk-free rate such as a treasury rate of comparable duration, as if you had, you know, to the lease itself, you know. So if the lease is 15 years, we're talking about a 15-year rate, something like that. And no, we're talking about the risk-free rate. You wouldn't be adjusting the risk-free rate. You would actually use the risk-free rate. However you look at risk-free rate, and most people would use a US Treasury rate of comparable duration. A similar question is, how would an entity calculate an incremental borrowing rate for an office space lease? Office space is not something that companies buy, so they wouldn't have similar loans. So that is a really good point. Typically, you won't often have office condominiums, so that's a little bit tricky. You may have to do a bit of digging around to find a office condominium that you would be purchasing and financing using your risk profile over a comparable you know, period to the lease. But again, that's, I guess, I'm not saying that would be easy for an office space lease as opposed to some of the other types of leases. But again, that's in theory what you'd be doing is you know, buying an office condominium, you know, of you know, a similar asset, you know, financing you know, a similar asset using a secured borrowing rate of comparable duration. All right. I think, any other questions on leases? I didn't think so. right?
I think that's about it, Jeff.
Okay, so let me turn it over to Nellie, I think, for the next part.
All right. Thanks, Jeff, and thanks, Liz. I'm going to spend some time here on our current agenda and also on our invitation to comment process, which promises to keep our current agenda full for quite some time. So if we can go to the next slide, this is a little bit of a snapshot of our current agenda. And as per usual, ourselves on the FASB staff and board are busy. We got a full slate of technical agenda projects, ongoing research activities. That's where a lot of the work from the ITC currently is, although it may move, and we'll come back to that, as well as our conceptual framework projects and our post-implementation review projects. And we'll go through each of these in a little bit more detail. If we go to the next slide, first, a few highlights on what is currently on our technical agenda. One of the broadest projects on our agenda currently is our project on identifiable and tangible assets and the subsequent accounting for goodwill. I think everyone has an opinion about this project. As you likely know, the board is moving towards an impairment with amortization model. So an entity would amortize goodwill on a straight line basis over 10 years unless they can support an alternate period. But Jeff is going to discuss this project a little bit more detail later in this section, so I won't go into more about that here. You can also see here we've noted the liabilities and equity project. This has been on the board's agenda for a long time in various forms, and I think it's fair to say that this topic overall, distinguishing liabilities from equity, has vexed standard setters the world over for quite some time. We made some progress on this issue on the accounting for convertible debt in particular within ASU a year or two ago. And our subsequent work on this is intended to continue by developing an indexation principle, but it's been challenging for us to make progress in this area. And as a sneak peek, it's not something we heard a lot of feedback on from our stakeholders in the ITC process. We actually do expect to discuss this again with the board here in the coming weeks, so stay tuned on that one. We've covered CECIL and TDRs and fair value hedging, and we're going to come back to supplier finance. So I'll just briefly mention the income taxes project here. This project was added to the agenda as a test of our disclosure framework to match up the disclosure framework against an existing topic and its disclosures. It's had 2 exposure documents, the most recently in 2019, with kind of a variety of different proposals about tweaks and changes to income tax accounting and disclosure. However, information about income taxes is a topic that got quite a lot of attention in responses to the agenda consultation. Again, I'm foreshadowing what we'll come back to in a couple slides. So this is something we are coming back to discuss with the board here shortly, and we may kind of reorganize this project a little bit and its objective, and we'll see how that discussion unfolds. As you note here, that we've got a link to our full technical agenda, which is always available on our website. If you want to peruse everything we're working on in great detail, that's all there. This slide highlights our current conceptual framework project, which relates to measurement. A few years back, the board set out to complete a full kind of refresh set of chapters in the conceptual framework. We've got concept statement 8, and we're filling in the chapters as we go. Closing in on completing all of those chapters, and measurement is up next. I'm going to save the discussion of the research projects for after we've talked about the ITC a little bit. And lastly, of course, as you heard, we're continuing our work on our post-implementation review projects, as Fred and Jeff both covered in the last section. This slide is a really helpful list of the final accounting standards updates issued kind of in the second half of 2021. I think we covered all of these from a technical perspective, so I'm not going to go into additional detail here on those. I will highlight some upcoming documents. As Fred mentioned, we expect a final ASU this quarter on troubled debt restructuring and vintage disclosures. Also not noted here, we expect a final ASU shortly on the portfolio layer method for hedge accounting as well. And we do expect an invitation to comment on government grants, as Liz mentioned previously. That might not be in the first quarter, but it will be shortly. Okay, so you may be familiar to some extent with this agenda consultation invitation to comment process and how it is unfolded, but I'd like to talk about it a little bit more. It is just a really important priority for all of us. And I want to cover some of the development in the background in order to kind of level set where we've been with this and where we're going. We have done agenda consultation, invitations to comment before, most recently in 2016. That one at that time was coming on the heels of several very active years of standard setting, right? Following major ASUs on revenue, leasing, and credit losses in the few years right before that ITC was issued. So the response there was a bit muted. We decided to undertake the process again last year. Rich initiated this as a priority. In our role as standard setters, it's just absolutely critical that we remain engaged with our stakeholders, get input from them on what we should be working on, where their priorities are located. So we started this process again. And what's so interesting to me about it is that we spent all this time and effort soliciting views directly from our stakeholders in order to prepare the invitation to comment document. So if we can move to the next slide. Throughout the first half of 2021, the FASB staff were conducting outreach with advisory groups, with key stakeholder groups to kind of try and identify priority areas of financial reporting. So we talked to all the different types of stakeholders that we have: investors, preparers, practitioners, academics. We also discussed all of that feedback with our advisory groups and advisory councils, including FASAC, our Financial Accounting Standards Advisory Council. These are some of our critical advisory bodies. They're familiar with what we're working on. They're able to help us prioritize and translate and kind of weigh in on the feedback we're hearing. You can see all of those different conversations and all of that background outlined here in terms of the timing of how that process unfolded. Ultimately, we spoke to over 200 stakeholders as part of the process before the ITC was even issued. And a third of those were investors. And that feedback was all synthesized and organized into the actual invitation to comment agenda consultation document, which was issued with great fanfare in June of last year. And if we go to the next slide, this slide gives you a little bit of an overview of how we organized that feedback and how the document itself was organized. Again, we're kind of trying to ask our stakeholders the right questions and make sure we put information in front of them that's useful so that we get really good high quality feedback and get people focused where we really need their input. And that was synthesizing it into these chapters is how we thought about it. Again, I personally think about this as trying to be efficient and effective with our stakeholders' time. Our investors, practitioners, preparers who respond to us have day jobs. Your input is absolutely critical to us in our process, but we know you're making time for us kind of in addition to everything else that's part of our stakeholders' responsibilities. So that's part of the reason why we spent so much time organizing and preparing for this document to make sure it was as effective as it could be. Now moving on to the responses, we got over 520 responses and we are thrilled with this level of response. Approximately 440-ish of those addressed solely the accounting for digital assets at fair value. You may be familiar, there was some Twitter support for accounting for digital assets at fair value. That we know that's a very important issue to a lot of people, and that's great. We are thrilled to get that feedback and to hear directly from those people and people who are passionate about that issue. About 80 responses addressed the ITC more broadly, which is to say commented more holistically on kind of all the various topics that we had outlined, relative prioritization, all the different things. And you can see in these slices that investors and other financial statement users were the highest category of responses that we received, followed by preparers and practitioners. Our mission is improving financial reporting for the benefit of investors and other users of financial information and allocators of capital. We are thrilled to get so much good input from investors as part of this process. And in order to receive that input, we were proactive in reaching out to investors. We tend generally not to get as many comment letters, which is a very common way we hear from other stakeholders. We get to not get as much of that type of feedback from investors. So this does include investors that provided feedback in response to proactive outreach and virtual meetings, where we will take the feedback in whatever form it comes, which is true for all of our stakeholders, but for investors in particular. And then we also continued to meet with our advisory groups other stakeholders throughout the second half of 2021 after the document was issued and into this first part of 2022 as we start to sift through all of this feedback. Just as a bit of perspective, in that 2016 ITC that I mentioned, the FASB received 45 responses. So our engagement was higher this time around, which makes sense given the relative positioning of what the board had been up to and kind of where we are in a broader life cycle of a few years worth of work. And in particular, the investor response to the 2021 agenda consultation was about 300% higher than 2016, which is in part due to that proactive outreach that I mentioned, to kind of proactively reach out to investors, ask them for their feedback, and make sure they're involved in the process. Moving on, we've got our these beautiful bar charts, which are probably small, but have a lot of great data in them. There were questions in the ITC asking for what the FASB should address. So both like, what should we address? What should we prioritize on our current agenda? What new topics should we add to the agenda? So on and so forth. This slide summarizes all of those votes, if you will, to note which topics were most frequently mentioned as a top priority by respondents. And it includes all stakeholder types. You can see our color coding carrying through here. This data can be interesting for me personally when to interpret it, because it doesn't reconcile this to the total number of respondents, which is probably obvious. People can vote for more than one priority, but this relative depiction of what was cited most frequently and how is very helpful for me in understanding what we heard, because 14 people having commented on something is different based on the relative positioning here. In addition, this chart shows the breakdown by stakeholder group. So for example, those pale blue sections are the investor respondents, and the colors match to the pie chart on the previous slide. So although digital assets was the most frequently identified topic as a top priority overall, strictly among investors, disaggregation was most frequently identified as a top priority. So there's alignment in a lot of broad ways among all our various stakeholder groups, and it can also be very interesting to observe similarities and differences among different groups of stakeholders, and then what that is attributable to. And if you were paying attention to the slide earlier that briefly listed our research projects, you may notice some overlap between those topics and the items at the top of this list here, and that is not accidental, and more to come on that. But next, first, continuing our same style of analysis, again, this slide is the same formatted structure, but oriented around things investors indicated that they were low priorities for us to take on. This is really helpful feedback for us. The FASB and ourselves as FASB staff and board have finite resources. We can't do everything at once. So it's really helpful for us when people can say, look, it'd be great for you to take this on in a perfect world, but this is not my highest priority, and here's why. Maybe speaking for us collectively, there are lots of topics that we would love to take on, lots of interesting but maybe less pervasive questions about accounting, but we can't do that. We have to make these prioritizations. And continuing that with that, depending on how closely you were looking at those top and low priority slides on our next slide here, you may have noticed some overlap, some topics that were on each of those two slides. So some things were mentioned as high priorities, but then also low priorities. So this slide is kind of like a net favorability analysis, like a net approval rating if you're politics people, on the topics that we heard in our ITC. So you can see there's a couple topics with really nobody identifying it as a low priority: digital assets, really, software, and then a few things that are much more mixed. And this is all really important, and again, really interesting feedback for the board to consider as they decide over the next few months what to add to our technical agenda and on which topics they want to focus. I have to take a breath, sorry, talking too fast. Continuing on, I'm going to briefly cover those chapters of the ITC that I had mentioned about how the document itself was organized. Generally, the feedback that we received in response to the ITC document from the respondents was consistent with the feedback that we had received when we were developing it, when we did all that outreach leading up to its issuance. So I'm going to briefly highlight each of these chapters, what we heard, where they aligned or didn't align, or what we heard. The first chapter of the ITC was really focused on the fact that investors are looking for greater disaggregation of financial reporting information. So that could be line items on the income statement, granularity of the statement of cash flows. And this was very consistent with respondents to the ITC, to what was in the ITC document itself. Investors and users just pretty generally agree. There's pretty wide agreement here that the greater disaggregation of financial reporting, performance information, and cash flow information should be a top priority. Investors tell us that'll help them better perform their analysis. Preparers do caution us briefly that we need to make sure to understand the cost benefit analysis and make sure we're thorough and transparent in how we do that. Preparers, for example, often say that they don't get a lot of questions on disaggregation from their investors who follow their companies, so that leads them to think that investors are getting sufficient information. So that's something that we can dig into a little bit more as we continue to work on this. And a common theme that we heard from investors is that they're looking for more meaningful insight in two kind of broad ways. The first being like fixed versus variable, or recurring versus non-recurring nature of income and expenses, which enables investors to prepare better forecasts. And the second one that we did here was jurisdictions and geographic areas, better disaggregation of that to assess risks, taxes, earnings, currencies, legislation, reputation, those kind of risk-based things could investors tell us could be better understood with better information about jurisdictions and geographic areas. On our next slide, we got a lot of examples of different types of disaggregation that might be useful from investors. So this is a whole bunch here to mention of those. You can see labor costs, you can see kind of human capital type things, you can see income taxes, you can see different types of growth. I'm going to take an excuse on this slide and highlight one area where we've already begun to incorporate ITC feedback into our existing technical agenda, which is this first item on this list about cost of sales and SG&A. The board has had a project on its agenda for several years to address financial performance reporting. It actually was part of the last ITC also. So that's the income statement, the statement of cash flows, how information is presented in the income statement. That project had been on hold for a year or two, kind of moving very slowly or not moving at all really. But in February, the board held a meeting on this project and decided to redefine the project's scope and objective. And the board is going to focus on providing disaggregation of cost of goods sold, cost of sales, and other costs of revenues, and selling, general, and administrative expenses. So this is a very targeted approach, focusing on those line items. Those line items are not presented by all types of entities in all industries, but they represent one of the areas where staff research and stakeholder feedback have both indicated that this aggregation currently exists. With the current level seems to be overly aggregated. They can be a very large percentage of revenue with no incremental disaggregation in the footnotes or in MD&A. So in light of some of that feedback and in additional research that the staff has done, the board revamped their objective here and is focused on kind of achievable standard setting in this area and what we could do here. Targeting this project and in this approach does present a couple challenges. So as I mentioned, not all entities present these line items. So that can lead to some challenges about which entities are in the scope of the guidance and how we do that. Next, even if entities present something similar, maybe they describe it differently. Maybe there's permutations of how they do that. Lastly, the definitions of what that is, what those line items are, cost of sales, cost of goods sold, et cetera. To the extent there are definitions, they are mostly located in the SEC's accounting guidance, not in the FASB's guidance or in kind of GAAP. And therefore, they often apply to public companies, but not private companies. So we have some definitional challenges as we embark on this project. We also have some questions about if our objective is to disaggregate those items, how best to require that. In the revenue recognition standard, there is a principles-based disaggregation concept. And based on the PIR process in our research so far, that has led to incremental disaggregation by entities of their revenue. And we've gotten good feedback from investors on that as well. There's also other possibilities about requiring certain types of disclosure, certain specific items to be broken out, or requiring some kind of quantitative backstop, like the line item has to be disaggregated until the greatest item is no more than X%, or something like that. So we've got some work to do in that project, which has been renamed Disaggregation of Income Statement Expenses. But in discussion so far with the staff and the board, this is a place where we heard very clear feedback in response to the ITC, and it aligns with things that the board wants to take on, and we're all very committed in working here to see what progress we can make. Continuing, the second chapter in the ITC document itself discussed emerging transactions. So these are areas where stakeholders told us that the guidance, there's not specific topical authoritative guidance, or GAAP has accounting that doesn't reflect the underlying economics of the transactions. And these are places where stakeholders told us that GAAP might need to be updated to keep it relevant. This includes digital assets, ESG related metrics, alternative energy tax structures, government grants. As Liz mentioned, we don't have recognition and measurement guidance in GAAP currently, and intangibles, including maybe revising some of the intangible guidance to be more relevant, considering how software has evolved in recent years. So this chapter also included potentially taking on a project to standardize metrics like EBITDA or free cash flow. Many stakeholders told us that these items mentioned in chapter 2 were a priority. Digital assets obviously was right at the top of many people's list of what they wanted us to address. The other top cited priorities here were ESG related transactions and disclosures and intangible assets, as well as government grants. Interestingly, financial KPIs and kind of non-GAAP metrics did not garner a lot of traction and was sort of mentioned as something that stakeholders didn't feel the need for us to take on. Continuing chapter 3, this was organized around kind of reduction of unnecessary complexity. So these are areas where the guidance might be overly complex. Sometimes, as Rich likes to say, sometimes complexity is necessary if the transaction is very complicated or for other reasons, but this would be the case where the complexity is not judged to be necessary. This included consolidation, distinguishing liabilities and equity, debt modifications. Consolidation got perhaps the most traction here in terms of a top priority. We got this feedback consistently that guidance is very complex, and maybe the board could take that on holistically. The low priority items in this chapter were materiality considerations for disclosure. So we had heard some feedback that stakeholders wanted us to provide guidance about whether a disclosure is immaterial, but that didn't seem like a relatively high priority after we got the responses to the ITC document, and as well as balance sheet classification, like current and non-current classification of liabilities and other items. Lastly, chapter 4 was related to improvements to our internal FASB standard setting processes. This was things like that we could do to help the standard setting process be more transparent and be more connect more with our stakeholders and so on. People were supportive of these types of things like codification accessibility or providing interpretive guidance, a structure to do that, beyond just the main gap, like, people turn to Big Four interpretive guides or other things like that. Is there anything else that we could do there to provide that interpretive guidance, as well as understanding better our cost benefit analysis? Stakeholders were telling us this will help improve your processes and also provide greater transparency to our stakeholders. So we're looking forward to working on those as well. Now, as promised, I'm going to talk a little bit more about the research agenda changes. I would say the public handout from the meeting in December is available on our website. It is 64 pages long. It's not linked here, but you'd be able to find it under recent meetings. It goes through everything I've just discussed, all the feedback that we heard, all the commenters, a lot of those charts and other things like that in great detail. I highly recommend it. And then in that December 15th meeting, Rich Jones, the FASB chair, announced changes to the research agenda in light of the feedback received on the ITC. So I'll make a very brief FASB specific distinction. We have two agendas, the research agenda and the technical agenda. The research agenda is emerging topics. The FASB staff is conducting research, and projects are added or removed from that by the FASB chair. Acting alone, the chair can do that as well. And that includes issuing invitation to comment type documents. The technical agenda is more of our active standard setting projects. That's from where exposure documents and final ASUs generate. And adding a project to the technical agenda requires a vote of the majority of the board. So as we consider the life cycle of these research projects, Rich added them to the research agenda in December. The staff is currently conducting research on all these topics, and the next step is to come back in front of the full board to determine whether or how they are added to the technical agenda for as a broader project. Hopefully, with a lot of foreshadowing in this section, none of these topics look surprising to you. If nothing else, they were all listed on the previous slides and at the very beginning. But I will briefly talk about each of these. So first up is everybody's favorite, the genesis of 400 plus comment letters with digital assets. So the project that was added to the research agenda is focused on holders of digital assets that are traded on exchanges. That would encompass your classic digital asset examples like a holder of Ethereum. And it would sidestep issues where other specific GAAP currently applies, like for broker dealers, or if a digital asset type arrangement is considered to be a security. That would not be in what we're contemplating here. I would emphasize that we're looking at digital assets and commodities together because they do have some things in common. And we did hear a little bit of this from ITC respondents. Actively traded on exchange, viewed as exchanges of value between parties. So there's a few things that we're looking at to see if there's an overlap between these topics and if there's one accounting model that could solve problems for both types of assets. But that'll be part of the board's decision about how to add that to the agenda would include the scope of what that would look like. Next, we have intangibles. This includes accounting for and disclosure of intangibles. We already had some research activities underway about other types of intangibles, so kind of re-upped that and added a consideration specifically for software, including related to internal use and external use models of software capitalization, and whether that distinction continues to make sense nearly 40 years after it was introduced. Next, we kept the hedge accounting phase 2 project on the research agenda. That was there before, but there's a lot of possible improvements that could be made to the hedging model that we'll explore as a part of that project. Then the project, Rich added a research project related to financial instruments with ESG linked features. ESG is a favored topic these days. As we all saw, the SEC propose climate disclosures this week, but this project is specific to a certain type of contracted feature. So let me give you an example to explain kind of what we're thinking of addressing here as this research project is currently constructed. So imagine a bond where the interest rate changes up or down based on achieving or not achieving a target, maybe based on emissions, or maybe based on a hiring goal or something else like that. The accounting for that type of instrument and that type of feature is what we want to explore here, starting with what information about that type of contract would be useful to investors. What do they want to know about that? What do they get today? How does that unfold? We heard from stakeholders that these types of instruments are expected to become more prevalent in the future. So we're starting to think through them now in anticipation of that development. And the other piece of that project is regulatory credits. That would be voluntary and mandatory emissions credit schemes and other things like that, which can exist for carbon in some places or for other types of emissions or regulatory credits. There's a surprisingly wide variety of that type of program. Lastly, as Liz mentioned earlier, GAAP currently does not include specific recognition and measurement guidance for government grants. So we're going to issue an invitation to comment to explore whether the model in IAS 20, which is, as we know, currently applied by many entities by analogy, should be incorporated into GAAP directly. The IAS 20 model is interesting. It makes some interesting distinctions about the type of grant, some interesting scoping distinctions, and it has optionality in some pieces of the model. So we're looking forward to the feedback that we'll receive from that ITC, hoping that some of the people who apply it by analogy today, as well as some of maybe the people who applied under IFRS, can give us some feedback on where there are practice issues, broadly does it work, so on and so forth. Lastly, the agenda consultation itself remains a research agenda project, so that's staying on the list. And then, of course, that it will stay on the list until we start to kind of wind down the agenda consultation initiative over the next few months, at least in this iteration or version of it. Over the next few months and over the summer, we've alluded to this, but you can expect to see the newly added research projects and other topics that were raised by the ITC come back to the board for further discussion. In particular, in the research agenda, case, decisions on whether and what to add to the technical agenda. The staff are busy doing all of that research, and then the agenda decision meeting would be a public meeting with the board. In addition, we received feedback on a bunch of other topics, existing projects, things we currently have on our agenda, things we've worked on in the past that are not currently on our agenda, so on and so forth. For those topics, we are expecting to come back to the board over time with a summary of what we heard. And in some cases, maybe that's a decision about what or how to move forward in light of that feedback. Those will be really interesting discussions. And then lastly, we are anticipating providing a summary of all of that agenda consultation activity and providing that to our stakeholders later this year. It's important to be transparent to our stakeholders who took the time to give us all of this incredible feedback. So about what we heard and what we're doing with that information. So we're planning that for hopefully this summer. And then I just want to highlight that this, wrap up kind of process, that summary, those activities over the next couple of months are not the end of the agenda consultation feedback. I expect this exercise and the immensely valuable feedback that we received to kind of reverberate through our agenda and our priorities and our research and the board's decisions for maybe years to come. So that's of course up to the board to make their decisions and see how this goes, but it's just an invaluable trove of really good information about what our stakeholders' views and priorities are. So that's the agenda consultation. I think I have supplier finance to talk about and then goodwill, and those are our two remaining topics. Just mindful of the time. I think we're okay, Jeff. Maybe I'll go quickly through supplier finance. Okay. All right. The supplier finance project is responsive to feedback received from users that they want additional information about this type of supplier finance program so that they can better understand how that impacts working capital, liquidity, cash flows. We added this to our agenda in response to an agenda request. The project is focused on disclosures to be provided by entities that use the supplier finance programs in connection with the purchase of goods or services. So they're the buyer in these arrangements. Keeping the parties straight can be a challenge here, but the disclosures would be provided by essentially the buyer. The programs can also be referred to as reverse factoring, payables finance, or structured payables type arrangements. So they give the supplier access to advantageous financing by leveraging the customer's stronger credit rating. So the buyer gives the supplier option to get payment in advance of an invoice date, usually. The gap is bridged by a third-party finance provider kind of intermediary. That intermediary is involved based on invoices that the buyer has confirmed as valid. So generally we can see that the buyer enters into that agreement with the finance provider and that they're confirming invoices as valid for the purchases of goods and services from their suppliers. And then the suppliers request early payment. So we got feedback that users are interested in these arrangements. We think they have been increasing, maybe an increasing trend in the number of days payable outstanding, and they want to better understand, users want to better understand payment terms and how buyers are extending payment terms with their supplier. There is also questions to be asked here about, there's a range of views about the presentation and the balance sheet of this type of arrangement and how it would be presented in the statement of cash flows. But the guidance that we proposed at the end of last year is limited to disclosure only. We've got general support and alignment around providing enhanced disclosure of these arrangements, and we wanted to focus on that as an achievable standard setting issue. The proposed guidance would require that a buyer disclose sufficient information about a program to allow a user to understand the nature, activity, potential magnitude, and rate of change of the program. So the specific disclosures would include the key terms of the program, and then for the obligation that the buyer is confirmed to is valid, the amount outstanding, where that's presented in the balance sheet, and how that amount changed during the period. So new obligations confirmed, and then the amount subsequently paid. We're focused on that disclosure of the confirmed amount the buyer has confirmed as valid to the intermediary. The board did consider, but decided not to require that the buyer disclose the amount of obligations that are actually paid to the supplier earlier than the invoice date. That's a subset of that accounting outstanding confirmed amount. The board's concern there was stakeholders indicated that that information might not be available to the buyer. That's a kind of separate agreement. So we've got the buyer and the finance provider, and then the supplier and the finance provider. The buyer may not be a party to that agreement between the supplier and the finance provider, or may not know for which invoices the supplier elects to be paid early. So what the board was concerned about requiring disclosure of that information if the buyer is not a party to that. This has been out for comment. The comment period closed this month, I think maybe yesterday. So hopefully you got your comment letters in. But we're really looking forward to hearing all the feedback on this, and we'll be back to the board in the coming weeks to discuss all of that feedback.
All right, Nellie, you can take a breath now, right? Okay, so I get to, I guess, wrap this up. Maybe I think we have an open question or two, but let me wrap this up by talking about a project that I've been updating you guys on for a couple of years now. And that is the project that has my vote for the most fun project at the FASB, our project on Goodwill. And I say fun because unlike some other projects where stakeholder eyes glaze over at the thought of it, seemingly everyone has an idea about, has their own views about what Goodwill is and how it should be accounted for, which makes this project fun. So this is a project that, is initially focused on public business entities, which right now are the only stakeholder groups that do not have the option to amortize goodwill, unlike private companies and not-for-profit organizations. And the board has been working its way through various issues over the past year and a half. And let's move on to the next slide. And has been indicating, I guess initially they were indicating tentative decisions. I think they've now been calling these leanings. I think what that recognizes is the fact that this is a very iterative project. Not only is the board considering previous decisions in light of further topics and that it then addresses, but also we are monitoring what the IASB is doing and their efforts, too. So the board we had two meetings since the October webcast. We had a meeting in November on trying to flesh out some of the details of an amortization approach. And in January, the board talked primarily about intangibles and whether to subsume certain intangibles into goodwill. After all the meetings, including those last couple, this is where the board currently stands in its decisions and leanings to date. And again, I'll talk about what's still to come in a moment. So right now, the board is leaning towards reintroducing amortization into the system for public business entities. And again, we'll see how that interfaces with the current alternative for private companies and not-for-profit organizations. It would be amortized over a default period of 10 years on a straight line basis. But unlike with the private company and not-for-profit alternative, an entity could justify not only a shorter period, but a longer period as well, with the longer period being subject to a 25-year cap. Again, all tentative decisions and leanings. In estimating the amortization period, we would provide an overall estimation principle, as well as some guidance containing some possible factors to consider in determining an amortization period. The board did not vote for a floor. We talked about a cap of 25 years, but board is leaning towards prohibiting a day one write-off, which would be an extreme, a short period, in any type of amortization model, and also towards prohibiting the reassessment of a goodwill amortization period that could be really very sticky in practice. So that's amortization. Impairment test, trying to simplify and improve that aspect of goodwill accounting. Board's tentative decisions, leanings, are to remove the annual requirement to test goodwill for impairment, but coupled with an amortization component to only test based on triggering events and circumstances. And similar to what we did with ASU 2020-103, which you may remember for last year, giving the reporting entity up until the end of the reporting period in which to do that assessment. And again, depending on the reporting cycle of the organization, it could be on a quarterly basis, it could be on an annual basis. For public companies, we're talking about a quarterly basis. For public companies, again, the leanings at this point is to keep the impairment test at a reporting unit level. But you'll recall that private companies and not-for-profits, in contrast, already have the ability to do the impairment test at an entity-wide level. The board did not choose to extend it to the entity-wide level, nor for that matter, even to an operating segment or reportable segment level. Again, all these are tentative decisions. And at its most recent meeting, the board expressed a leaning to not separately break out what one board member characterized as wishy-washy intangibles, which are basically our contractual and non-contractual customer relationships, to keep them as part of goodwill unless they are separable, meaning unless you can separately license or sell them apart from selling the business as a whole, the organization as a whole. So again, those are the leanings to date, but let's go on to the next slide. There's still some major topics still to be discussed. One of those is where to present amortization in the financial statements, whether it's within net income or outside of net income. And some would say, and we're also going to be looking at, asking the same question about impairment, to try to determine what types of disclosures may be required as a result of changes to the accounting model for goodwill. That's what we call consequential disclosures. We're also, by the way, monitoring the IASB's work here, where they are proposing, or at least contemplating, haven't yet proposed them, disclosures about the success or failure of a business acquisition and metrics around those. Again, we are monitoring it. I don't yet know if the board will have any appetite for that, but that's one of the things we'll at some point be discussing with the board. And then a really big one, which is, okay, what do you do with those trillions of dollars of goodwill that are already on balance sheet? In other words, transition. How do they come off of the balance sheet? Do they come off kind of a lot of it all at once, or is it taken off on a much more gradual basis? The whole area of transition is still a big one to discuss. And then finally, as I mentioned before, as we talk about sweep issues, miscellaneous issues, trying to wrap up discussions later in the year. One of the things we'll be talking with the board about is the relationship of these decisions to the existing private company and not-for-profit alternatives, and whether any tweaks are needed to those existing alternatives. The goal here is to, at least the best current goal is to, again, continue to monitor what the IASB is doing, discuss these other matters with the board, have the board make decisions on an overall cost benefit basis for all of these matters already decided or leaned towards and still yet to be discussed. And perhaps put out an exposure draft to propose a comprehensive proposal by the end of this year, if not perhaps early in 2023. So again, stay tuned to that. We'll be updating you some more on this project in October at our next semi-annual webcast. With that, Liz, I want to see if there are any other questions we can answer.
Yep, so thanks, Jeff. There was just one other question that I think Fred might just briefly touch upon. It's relating to how does the FASB go about analyzing information that might be considered sensitive or of a competitive nature, in particular as it relates to the disaggregation of performance information project, and how do they think about those types of things when they're making decisions? So Fred, if you want to just, if you don't mind, just maybe briefly touching upon that question, and then we can probably end the session because we don't have any other questions after that.
I'm sure, Liz, and I'm speaking as one board member, certainly not for the board on this issue. I think one of the, certainly disclosure of competitive information is something that the board would take seriously and does take seriously if we believe something that we're asking could do that. That said, I think when we look at what we're looking at in the disaggregation project specifically, as Nellie said, we're targeting areas where it's clear from investors the disaggregation is not significant, is not there for investors to disaggregate. On the other hand, we're not looking at areas where we believe there may be disaggregation that's appropriate. Let me use an example. We're looking at disaggregation of SG&A. Analogous to that is financial institutions who disclose non-interest expense, which is very analogous to SG&A for banks. Having been a bank analyst, I know that there is meaningful disaggregation of non-interest expense that allows analysts to independently assess trends and the difference between fixed and variable and really get a good handle on those line items. As a bank analyst, I never heard from banks that disclosure that is currently there creates a competitive disadvantage for those institutions. So when we look at SG&A, on the one hand, we are certainly open to hearing that disaggregation could cause some kind of competitive harm. On the other hand, we're also very much informed in areas where we know there is disaggregation that is analogous and has not caused any demonstrated competitive harm. So I hope that this provides some input on that question. I mean, it's clearly an issue we do take very seriously, but we're not just informed by the feedback we say that it is competitive harm. We want to make sure that it would be, and that it would be to the users of financial statements that would consider it that way.
Thanks, Fred. That's helpful. And just thanks everybody for all the presenters. We appreciate it. And thanks all the participants for your questions and for attending. And again, please look out for the survey. And this will also be archived for anyone maybe in your organization that wants to listen to it, or if you want to go back and listen to anything again. With that, we'll hope you all have a great day, and we'll see you next time.